if you look at July, August, and September, what you see is 6,000 tons of silver left the London vaults. This is an incredible number. Just try to picture 6,000 tons of silver bars being taken somewhere.
It's a question that comes up all the time, and trying to think about where to park money, because nothing's really worked except, like I said, the dollar, which is up, and that wouldn't be
right. You're losing. I mean, it's kind of one of those investments that I think it's the biggest nonsense type investment is the Treasury inflation protected securities. It's an investment that cannot win.
Daniel, how are you today? It's silver and gold day here at Investing Counterpoint.
My favorite day. If there are silver bugs, then I'm one of them. I know it sounds people. I will explain. There's a lot of investments, a lot of diversity. There's some scientific arguments there. Welcome everybody to Investing Counterpoint, the show for financial advisors about protecting your clients' portfolios, risk management. I guess it's not just financial advisors anymore. Last video on YouTube got almost 1,000 views. Right, guys?
That's pretty good. Yeah, we're getting there. It's a slow slog to start a YouTube channel. All those people that think being a YouTuber is easy and you can just get millions of subscribers, it's not that easy.
It's a lot of work. So don't forget to subscribe to the channel, because we're going to be doing this weekly. We're going to be giving you some really interesting takes and a lot of useful data. So let's go, Yon. What are we going to talk about today? What do we start with?
Well, you want to start with the Fed. I mean, the Fed, this sort of, because a lot of everything that we talk about is driven by the Fed and the policies of the past 12 years now, 12 plus years, and they continue to. I would
argue it's since 1987 when Greenspan started this whole thing.
All right. Well, we can squabble about the date. It's a long time. But the past Fed day, I think, was a pretty interesting day, right? When the Fed again raised 50 basis points, but 75. You were just 75 basis points. I'm sorry. You kind of just told me about something that was pretty interesting, I think.
And you were traveling. You didn't know this. This was a very funny day. It's like a quintessential Twilight Zone moment when you realize that, hey, you studied economics, you studied about production, and you studied about all these things. And in the end, none of that matters. Technology, it doesn't matter. All that matters is what words Jerome Powell uses to describe his. So, like, imagine him being like hangover, or he had a fight, and all of a sudden, like, it's just one word, right? There was one word in the statement that the market interpreted. The 75 basis points hike is not necessarily dovish, and but there was
nor was it a surprise.
It was exactly what was expected, but there was like one word or a couple of words that people considered dovish. That we're gonna pivot back, we're gonna come back. The good old times will be back, and then the market took off. It was off to the races, and then the Powell came out later in the day, visibly frustrated with that, and said, "You know what? No. There's a lot of pain. There's a lot of pain and shocks." And boom, you had like the worst ending to the day, right? You have that chart. Do you have that chart?
I do. Let me pull it up. One thing that I do want to say, though, is that they do, as far as I know, they do absolutely agonize over the words that go into that statement. I mean, every word.
That's probably why he was frustrated.
That's exactly why, because if they change one word, or if they do one word, it's very intentional. They don't put things in there. So that's why, it's almost funny when you say, oh, they said might instead of may. What does that mean? And they actually do, from what I know, they do actually agonize over those individual words. So that when you see market participants saying they changed the wording, that's a dovish sign. They're it's their best guess, obviously, but they're reading those words very, very carefully. They're parsing out this statement relative to last statement. So when there's a word in there that's taken, like we have here in the middle, where you're kind of saying it started to take off here for 45 minutes or so, and I don't know what the percentages are here, but up 50 to 75 points in this short period of time. Before, this must be the period that you're talking about when he said, no, exactly. That's not what I meant.
Exactly.
And then, we lose, what is that, 150 points into the close or so, or
yeah.
So yeah, I mean,
quite a big, biggest drawdown toward the end ever on the Fed day. That's what I read somewhere. I read it on Zero Hedge. That's what they calculated. So you can almost imagine this picture when you have Powell is like a conductor of an orchestra and the markets are just swaying to the music of his destruction, you know. It's really, really funny. But anyway, so to the serious stuff, what does it mean, right? What does it mean for your portfolio? We continuously talk about the fact that you don't want to be predicting things because, right, you can't predict a word that you can't predict a word or a few words and the emotion. There's so many things in the short run. You need to understand what the possible impacts on your portfolio are. And from a few episodes back, if you just joined the channel, the first video you're watching, we talked about inflation and how to inflation, stagflation, how you protect your portfolio against those things without sacrificing the return. Right? You want to just make sure that yes, you put some investment in there, and you need to be conscious about what you spend on risk, right? Because risk is just like a transaction cost. When you incur risk, like an inflation risk, that is a transaction cost. You have to make sure to be paid for that, and you're going to be paid for that in alpha, right? So if there's a case where there's inflation and you are losing money somewhere or not gaining enough to keep purchasing power, you have to be sure that those assets that are losing you money are something where you're strongly convinced that they're going to help you either in the long run or in all other scenarios, right? So we want to make sure that you're conscious about building your portfolio. I'll show you some stress tests later. The fundamental thing is that we're living in an inflation environment. And I think it was a foolish idea to begin with to think that a Fed hiking rates to 4% can stop an inflation that's like, 8 or 9% at least, which is, I think, calculated incorrectly. So the Fed rate has to approach the rate of inflation at least, right? So the real rate has to be close to zero for one thing. For another thing is much of this inflation is supply driven. It's supply issues. You can't fix supply issues by making money more expensive. So
but you can by slowing down the economy and
exactly only by breaking. It's not even slowing down. I think this is not a case. You have to create a serious crisis, and that is a possibility that you have to consider, and that's the different angles that we talk about in different episodes. So what is the scenario here? We're looking at inflation, and even Powell said that, we're exactly where we were a year ago. Those were his words in the press conference. Said, we've done all these rate hikes. There's all this, stuff going on, but nothing changed. We are, from the data standpoint of inflation, we are exactly where we were a year ago. That should tell you that we are far away from solving this problem.
Right. Yeah. That all these rate hikes of the year haven't done anything to tame inflation.
And it's a cumulative effect, but he basically said we're going to go much further. So in your portfolio, what are the inflation hedges? By the way, please leave a comment. You can leave a comment and tell us what do you use for inflation? What do you hedge? How do you hedge inflation? We'll talk a little bit about commodities, specifically metals. Right? We'll talk about metals. But Yon, what do you think? What are the good inflation hedges that we could try in our stress test?
I mean, there's a couple, right? There's the traditional one that everybody tries, which is tips. There's gold, which has always been, you talk about metals, which is kind of the point of this podcast, or the topic of this podcast.
Yeah.
We talk about gold and silver as inflation hedges. Really, the only inflation hedge that I've seen that's worked is the dollar, which isn't supposed to be an inflation hedge per se.
That's pretty amazing, yeah.
Yeah, but it's pretty amazing. I mean, I did bring up some charts of gold and inflation, and should I show those now?
Yeah, you can start with that, and I have a couple of charts to show as well.
Okay, cool. So let's go here. I'm going to share my screen again. So here's a quick chart of gold and inflation, and the blue line here is inflation, and this is gold, and we'll see this in a couple different charts, but we can see, and this is I only did year to date. We're looking at short periods of time, because what we're seeing, or what I think that we're seeing, is a bit of a breakdown of these traditional relationships, and it's happening in this crisis, or in this current environment. So I didn't want to go back too far and see, and I have a couple of charts that I'll show you that show you what the relationships have been historically. But right now we see that, at the beginning, gold was going up with inflation. It was working as a hedge, but then it stopped. It kind of stopped working and started to come down here. Now the question is why? And one of the main reasons why, I think, is this next chart that we have, which is gold against the US dollar. When I said that the only thing that's really working as an inflation hedge is the US dollar. This is the thing that's been rising the whole time, but gold is priced in US dollars, and gold and the dollar have an inverse relationship historically. And I'll show you that in a moment too. But, I think that a lot of gold not working is because the dollar was so strong that it's kind of curtailed the price of gold. So I think this was a pretty important.
In other words, the approach from the words and intentions of the Fed created lower inflation expectations. So people looked at it and said, you know what, they are really going to get it done, and inflation will be. So it doesn't much matter that there's inflation now, but we believe. Notice how the markets are getting further and further away from fundamentals into the belief area. Like that's why I think it's from the system is very broken. But the idea is that we believe that the Fed will unwind and there will be no inflation. Therefore, it's not productive to hold gold now. That I think is what's happening, other than possible gold manipulation. I know there are a few court cases percolating right now that the traders do manipulate gold price to the downside. But probably that's not the only answer, right? There's not the only answer. The big answer is that you're right. The dollar is up. There's no fundamental reason why the dollar should be up when inflation is high. Right? There's absolutely none. It's only the fact that the Fed shows determination, right? It's only the intention of the Fed that's driving the whole world financial system with they're not trillions, they're like quadrillions of dollars in derivatives now. I mean, this is insane what is out there. We should do a separate video on derivatives, but all of that is being driven purely by the Fed intentions.
Well, I mean, you
the
bring
signaling
up a
of
good point.
intentions. Yeah.
This is back to the first chart, but I also want to clarify, this is a gold and silver index. It's not just the price of gold, it's a gold and silver index. So
silver did even worse than gold, I think.
So I wanted to combine the two as opposed to showing a ton of charts, but you can kind of see how it worked and then still worked here. The gold price comes down as the inflation expectation kind of came down, and it sort of broke here. But I think your point is the expectation was that they were going to get it under control. And they've started to. I guess we'll see what the next week comes out a new print on inflation. So we'll see where that is, and see what the reaction is. But the market always trades on expectations. It's not what just happens; it's what they think is going to happen. So if they think that the Fed is going to get things under control, maybe that is part of the story of why gold went down. But I think it's also this story of gold and of the dollar rising against gold.
This is clearly the case of the tail wagging the dog, because there's no fundamental, nothing about fundamentals, nothing about economy, nothing about technology, nothing about how productive the investment is. It's purely thinking about the intention, right?
And some trouble with some other current. I mean, you think about the pound and some of these other currencies that are struggling. So that's relative dollar strength.
The Chinese yuan had a good couple of days, but again, why did it have good 2 days? It's pretty amazing to hear. It is because there are rumors that they're about to lift their labor camp policy, whatever. I'm not going to use that word, but so it's just a rumor. It's not confirmed rumor. So again, it's got so we're seeing this market that's driven by these factors that you never thought that you would be analyzing that, but you kind of have to. So I have a couple of charts to show as well. If we jump to silver, do you have anything else?
Some years, and then we can jump back to everyone's favorite charts, which are correlations, which I have a few of those as well. I know they love the correlation matrices.
Let me show you a couple of charts. So first, I want to talk about the silver. I'm a fan of silver in general. I think that monetary metals are not a barbarous relic, as John Maynard Keynes once said. He called gold a barbarous relic. I think that it serves a very useful social purpose, because money should have some properties, right? It should be predictable supply is really one of the very, very important properties. Predictable, transparent supply, divisibility, and so on and so forth, durability. And gold does serve that purpose, because you can't print gold. Well, you can. I will explain how it's printed today, but there was hundreds of people, thousands of people in Middle Ages that looked for philosopher's stone to try to print gold, but only in the 20th century did they find it. But before I talk about the philosopher's stone, let's look at, this is LBMA, right? London Bullion Market Association. This is their vault. This is the actual gold. This is not the paper price of gold. This is the actual gold that you see here, and this is the actual silver. I think this chart should be shocking. Why? Because, London Bullion Market Association is the primary gold storage gold dealer in the world. There's COMEX, but it's smaller. And you see here an amazing trend in the last few months. Look at that. The silver is leaving the vaults. Now, where is it going? Is it going to COMEX? Is it going to some other exchange? I'm not seeing that. In fact, COMEX also is experiencing silver outflows. And silver has been a monetary metal for a long, long time, right? Mm-hmm. In fact, there was a whole debate before, U.S. got away from the metal standard altogether. There was a debate of whether you have a gold or a silver standard. Remember, I think it was William Jennings Bryan with his famous cross of silver speech. You're crucifying the working man on a cross of gold. Give me silver, because silver is like poor man's gold. It's more democratic kind of monetary metal. It's a very interesting history. So gold clearly, is stable here, right? Mm-hmm. Fairly stable, going down a little bit. But silver is plummeting. And just right. And we only have data through September. I'm anxiously awaiting data for October. I don't know why they wouldn't release it. Is it so hard to count silver? I mean, this is November 4th, but it's not released yet. They will release it. But if you look at July, August, and September, what you see is 6,000 tons of silver left the London vaults. This is an incredible number. Just try to picture 6,000 tons of silver bars being taken somewhere. And in fact, the level of silver that is not so, the silver in the vaults is owned by investors, the trade on the exchanges, and it's also owned by the ETFs. Right? Mm-hmm. The ETF silver is kind of spoken for. It's not a silver that you can trade per se. The ETF needs it for legal reasons. So only the non-ETF silver is available, and there's even less of that. And now, so that silver that's in the vaults that underpins all the silver trading. And so in reality, what's happening is that I think the ratio is like 15-1 of the actual silver traded to the physical silver. What they're doing is they're taking some silver and saying, hey, you own this, and now you also own this. And that's the way to print silver, right? Yeah. 15 people own the same silver bar.
What's the ratio with gold?
You printed 14 of them.
What's the ratio with gold?
I think it's quite similar, actually.
Is it?
I think it's similar, yeah. So the paper, that's why this is, again, it's the same idea. It's the dog, the tail wagging the dog, because you have the paper market coming in there. And I watched the gold markets where you see that there's a huge sell of gold all of a sudden. And you wonder, does this trader even own that gold, or is it just like a kind of fiction, right? That's written in that supposedly they own it, and then they bring down the price. But when you look at silver, something doesn't add up here, because if you look at the chart of silver, I'm not going to show it, but you look at the silver price over these months, it was actually dropping. Now, does that make sense to you that the price of silver is dropping and people are just like taking out silver out of the vaults? It makes absolutely zero sense to me. Because if the silver price is dropping, you should have more people here. Take my silver. I don't need it. It's it's losing value. No, it's not so. I don't know what the answer is. I don't have the big conspiracy fact here. I don't know what it is. I just know that this is what's happening. To me, this is a bullish sign for silver. Right? To me, there's a mismatch. There's a major mismatch between the paper market and the physical market. And I checked this. I was asking around about silver coins. I know that like 1 ounce silver coins, which are the most popular, you have to pre-order for 2023 now in many places, where you have to pay a premium up to twice as much, 2x the price sometimes. And it's not a collectible coin or anything. So this is telling you there's something going on with the physical silver market that is not usual. And so this might be the answer. Whatever the answer to this is the answer to the question of why silver hasn't been a better inflation hedge. I don't know about gold. Let's leave gold out for now. But to me, when there's clearly demand, and we see from many places there's demand for silver. There's a lot of quotes, there's a lot of data points, there's a lot of demand for physical silver. It's not translating to the price. Why? I don't know. But in my opinion, right, regardless of anything, you should you could consider that in your portfolio as one of the inflation hedges because it is non-linear, right? It is not a hedge that's like you hedge it with an option that has a delta gamma. It's a highly non-linear instrument. In other words, for a long time it may not hedge, and then it will. Of course, there's risk to that as well. But I think that the idea, again, going back to your chart, if people believe that the Fed will get inflation under control, then what's going to happen if they stop believing that? Well, that's it, right? The dollar will stop rising and gold and silver will rise as well as other hedges. And that's what you're really thinking about. That should be one of your scenarios, right? You can't operate believing that the Fed is omnipotent, that they will get everything done, they will solve the inflation. We don't know that. They may or may not, right? It is not a given fact that even breaking the economy will solve inflation. You could easily have stagflation. So my point in this scenario is that you should consider this data and you should think about having that as a hedge in your portfolio, right?
Yeah.
And the other hedge, I mean, what are the alternatives though? We talked about gold and silver not performing, but remember the preeminent hedge that is suggested to us by Wall Street is TIPS, right? TIPS. I looked at the net asset values of the prominent iShares TIPS ETF. Look at that. That is much worse than gold, much worse. Obviously, the return of the TIPS has two components: the interest rates, like a regular bond, and the inflation spread, the premium for inflation. But you know what?
Can you shorten that to year to date, that chart, Daniel?
Yeah.
Yeah. So it didn't. Yeah. So even in the it kind of looked like it was going up in the beginning. It's
yeah.
really
It probably has some correlation to gold too, right? Because of that, because the same thinking. But it dropped. You know, after this, it dropped much quicker.
Yeah.
So to me, like you were holding this TIPS. Whoever holds TIPS, you're holding it for all these years. You're paying this premium, right? You're paying insurance essentially for inflation. And then when inflation comes, you pay even more. Right, you're losing. It's kind of one of those investments that I think it's the biggest nonsense type investment is the Treasury inflation protected securities. It's an investment that cannot win. It's not even like casino. It's much worse. It's like you always lose because when there's no inflation, you lose by paying a premium. When there is inflation, then there's Fed action or things happening to the interest rates that hurt the interest rate component of your investment much more than you make on inflation. So
right.
To me, TIPS is an absolute nonsensical investment. I'm sorry. If you hold it, I don't believe that it makes any sense. Look at the inflation break-even rate from St. Louis Fed. Look at this. I mean, even now it's like 2.4. I mean, this is supposed to be the implied inflation rate from the TIPS spreads, from the Treasury inflated protected securities. And this is what they're really telling you. I mean, never does it go up anywhere realistic. So it looks to me like this instrument is constructed to always lose. It's like one of those investments that were created before 2008. There were these derivatives that always lose, and this is one of them.
It's interesting. Before, it was working when markets were, back in 2018, 2019, right? Because you had, 1 to 0%, 0 to 1% on the 10-year, and you're seeing, somewhere around 2% spread, which implies a 2%, inflation if you're at zero. It makes some sense, but when you see what's happened year to date, and it only goes up to 3, which would imply, well, I mean, it's not that far. I mean, that would imply, I don't know what it was back in April, but today it's implying it's 2.5. It's implying what are we at 4 on the 10-year today?
I mean, it's a 10-year rate, so it is basically saying that hey, over the 10-year period they will get it under control. This flies, by the way, contrary to all the data we've ever seen. Once inflation starts, it's extremely difficult to get under control. I mean, look, you just had Powell the other day say exactly those words. We've been doing this for over a year. I mean, the Fed has had a massive intervention. Many people didn't even believe it could get this far without breaking the economy because just the interest rate payments on debt, and there's so many different interest rate components that were broken during the quantitative easing. Many people didn't even believe they would get this far, and they got this far, but they got this far with zero result, according to Jerome Powell, nonetheless, right? So I would urge you to consider what other inflations, and put in comments what other inflations hedges we can actually look at. But TIPS to me is not a hedge. I think it's a robbery. Metals, I think they're partially manipulated. They also suffer from some problems, but I think they should be an investment that you can hold, especially looking at this chart. To me, there's something real about this. This is real silver being in demand. To me, this is a demand chart because nobody proved to me, and I've asked people where this silver is ending up. I think it's ending up in some personal votes or whatever, maybe central banks. I don't know. So last thing I will show before we go to your charts is portfolio crash testing. That's an app we built for advisors where we stress test portfolios. And this is a portfolio I use in our videos. It's a moderate risk portfolio, except I added a silver future, 15%. Now, that's a huge amount. Admittedly, this is for somebody like me, not necessarily for your clients, because it's an investment that doesn't yield. You can't be in it for too long. But again, it depends on what other parts of the portfolio do.
Well, the other thing about putting a big position like that, Daniel, too, is it will amplify the effect. So for to show what's happening, you put a big position because you have to have a meaningful position to really show what's going to happen with the silver future. If you put in 1%, we're not going to see it in 100%.
That's right. I wanted to show it, but also for me, it's a high alpha position that I'm willing. For me, it would be a high alpha position because of this chart. Like I struggle to find an analogy for this. Where else do we have an asset that is seeing this with the price being static or dropping? I mean, to be fair, silver rose a little bit, but very little. So look at the stress test. We have inflation, stocks up 30%, but I highlighted here rates rise inflation. In the rates rise inflation scenario, we have this is an inflationary boom, and it's not quite what we're seeing. We might actually see stagflation for all I know, but in the inflationary boom type scenario, when rates are rising and the economy is booming, you see the silver future is adding 16%. This is a $100 portfolio, so dollar and percent is the same, 16.2%. So in other words, it's got a very significant impact, and this whole portfolio has a 30% return, despite bonds losing some. But it has a 30% return, and more than half of it comes from silver. That's how outsized it is. Typically, people think that stocks, for example, that stocks are also like we have a S&P 500 index at 7%, but they're going to do well. And then we have the equity dividend, which should do okay in inflation. So is low price stock. But these things are all combined contributing less than the silver future. So what I've shown here is both theoretically using the math of the model and practically there's a reason to have some inflation hedges, and silver should be one of them just because of the unique setup that we're looking at right now.
Yeah, it's interesting because if you think about typically when rates rise and there's inflation, it's like the economy is really strong, which is kind of what we're seeing. We haven't seen the back broken of the economy yet, right? Because we've talked about demand is still somewhat robust. They haven't broken demand, which is why inflation, the supply chain hasn't broken down. It's right. Starting to. We're starting to see these things. To be fair, I mean, this is starting to happen, but we still have 3 point something 5 or 6% unemployment, very very low unemployment. So we're seeing, but what we're not seeing this time is we're not seeing the stocks rise in concert with the rates rising. And I think it's because of the idea that the Fed has kind of said that they're going to cause a short-term pain and that they might actually crash the economy. So we do have a little bit of a different scenario than what we might have seen in the past with this kind of thing. But your point about gold being this inflation hedge, or gold and silver potentially being this inflation hedge is really interesting. The silver one does intrigue me after seeing that chart. That it wasn't something that I was, looking at my charts and the correlation and just seeing what's happened with the prices and seeing it that gold might be more of a dollar store here. Your chart of demand of supply and demand dynamics is really interesting. I think that's a real key to look into on the silver market.
Yeah, and actually in COMEX, which is another silver market, it's the same story. It's losing physical silver. It's like leaking everywhere, And remember, silver, there's actually a lot of production of silver annually. I think it's something like I want to say 30,000 tons or something like that per year of silver produced. And so they're taking all of that off the market and they're invading golds. That is a serious sign. Remember, silver also, unlike gold, has real industrial uses.
Yeah,
it's got in particular very prominent use in electric batteries. So about 10% of demand nowadays of silver comes from electric battery,
Mm.
and it's got other industrial uses. So again, I'm not saying that silver is end all be all. To be fair, I do own it, but I believe that the situation right now is very, very strange. I've never seen such a situation without something breaking, and in this case,
Yeah.
silver breaking to the upside. But even if I'm wrong about these dynamics, what you should realize that I showed you a chart in portfolio crash testing. I'll show it again one more time. That this is a chart that's got nothing to do with London volts, right? It's a purely mathematical model of risk that we use for our clients. And so when you look at this chart, it also shows you that the silver is a good protection against inflation. So for me, silver could be used on two counts, right? It's a good diversifier, but also it's got potentially high alpha due to the demand situation.
Yeah. Well, that's really interesting. I mean, I think it's really something to think about in terms of an inflation hedge here, because, you know, I wasn't, it's a question that comes up all the time, and trying to think about where to park money, because nothing's really worked except, like I said, the dollar, which is up. That wouldn't be.
Typically, people put it in tips because it says inflation. Yeah. Just because it says inflation, you know what, doesn't mean it will do anything for you.
You know, since to be fair, since tips came out, I don't know if there's been a real inflation test like we've had.
Well, we're having one right now.
No, I know. I mean, until now. So I mean, to think that it wouldn't work, or, you know, I still think that there's some, you know, I have to look at it against the 10-year bond price, because I think it probably has outperformed the 10-year bond. But the question is by how much? I mean, that's what your inflation protection would really get you. So
I was skeptical of tips for a long time, precisely for the reason that when you look at the modeling, you understand that, hey, when in the case of spread, spread basically spread doing what you want, right? Basically, inflation expectations rising, you're going to be losing on the interest rate increase. So the tightening of the spread will be more than compensated. It's one of those investments that you never win, I think.
Yeah. No, that does seem to be true.
All right. Do you have any more charts, or shall we?
No, I mean I do, but they get into the weeds a little bit. I think this is a good place to leave it. I don't know if anyone wants to go into my correlation matrices today, so we'll.
I think we should. Maybe we can leave it for next time. And this is a very interesting topic. I have more to talk about on silver, because I think it's very topical now, and we can also look at commodity charts next time. Yeah,
I mean, one thing to just mention is that these relationships aren't always stable. You can see different cycles when you have gold and silver working against the dollar or against the S&P. These aren't stable correlations. These aren't things that have a one time fits all profile. So, the situation, especially with these commodities and these, inflationary hedge type instruments, they can definitely do different things in different market cycles. So, well, thank you for watching. Please subscribe for the next show, comment under the video. Next show, we do it weekly. Mostly Yon was traveling at some big conferences. Maybe you can tell us a bit about that next time, since we used up all the time. He was at Schwab Impact, and what was the other one? The other one was Finlocity conference. So, outside Las Vegas. But we're catching up with this video, and subscribe and stay tuned. Thank you so much. Yeah, thank you.